we are going to look at some questions, specifically item pass questions on ratio analysis. We're going to start with that of last diet. So last diet, there were 2 questions on ratios last diet. So this is the first one, which was the B part of the question 1. So in line with how I advised you to always approach the exam, you look at the requirement of the question first. What was the question asking you to do? Here, the question wants you to discuss the profitability, gearing, and investor stake in Badari PLC, and recommend strategies for improving or sustaining them. The examiner is ready to give away 10 marks for that. So the question wants you to discuss profitability, gearing, and investor stake. So how can we discuss these 3 key items when what the examiner has given us, they gave us the statement of financial position of Badari for 2 years, and they gave us the statement of profit or loss of Badari for 1 year. They want us to discuss profitability. So how do you do it in the exam? Two ways. If it were you, when it comes to profitability, gearing, and investor stake, profitability first. Of course, my focus will be on P&L to see how profitable this company is. I can see that it's making profits, but I don't know whether it's improving or it's declining because they didn't give me information about its profitability in the previous year. And also, they didn't give me maybe an industry average that I can compare with. So how do I do it? The only way I can achieve what I need to achieve is through ratios. So I will need to compute ratios relating to profitability, gearing, and investors' stake. Then I'll be able to then discuss those ratios. Then that will be my answer for the examiner. So look at the solution I came up with. I started with profitability, and I told the examiner that the revenue and profit for the year of Badari PLC of Badari PLC seems robust, but we need to compare these absolute figures with the resources that were employed to generate the profits and the sales. And I told them that let's look at returns on capital employed, gross profit margin, and asset turnover to assess the profitability of the company. You see, I just used it like an introduction to what I want to do. I told them that, yes, this company is making good sales, they're making good profits, but for me to talk about their profitability, I will need to understand and compare this profit and sales with the resources that were employed to generate them. So, and I told them the ratios I will look at. I intentionally chose 3 because my eyes is on 10 marks. And I've already, I've narrowed my mind that by the time I do 3 ratios in profitability, then another 3 in gearing, then I look at what I want to do in investors. With my explanation, I would have done well to get 10 over 10. So Returns on capital employed, I gave them the formula. I intentionally use profit for the year over equity because I can easily just pick my profit for the year. If I don't want to use profit for the year, I could have possibly used PBIT. But if I'm using PBIT, that means that my capital employed will be equity plus debt. If I want to use PBIT, because that's the profit that belongs to everyone. But PBIT is just a long way. I will still have to do it, but let me just quickly, this still also measures we'll see. So I get my profit for the year, which is 216,500 from here. My profit for the year, all upon equity, which is 560,000. For my statement of financial position, 560, this is my equity. I multiplied it by 100. It gives me 38.7%. Then I did gross profit margin, which is gross profit over sales. The gross profit given in the question is 268,000 and the sales is 490. Then I have 268 over 490 times 100, 54.7%. Then I did asset turnover, which is sales over capital employed. My sales is 490. My capital employed, I use equity plus debt. I used equity plus debt for my capital employed, which is this equity plus this long-term debt. That gave me my capital employed. Then my asset turnover is 0.8 times. You need to remember that asset turnover is times. Now, this question isn't about just computation. The examiner actually wants us to discuss. So you need to discuss. So, and I then said from the ratio above, I told the examiner that it is difficult to judge whether the ratio indicates healthy profitability because there is no sufficient data to compare with previous years or industry average. Because what's the only way you can make a ratio, you can make judgment on ratios is by comparing with previous year or with industry average. You cannot just look at a ratio for the year and say, this company is profitable. No, that's not how it's done. But I then told them that, however, that a return of 38.7% on capital employed is good enough. And I said, it is even higher than the current Nigerian NPR of 27.25%. I intentionally, whoever is reading this knows that this person knows what he's talking about. That this company is making 38.7%. And if I had gone to borrow money in a bank, the minimum borrowing rate right now is the NPR. And they are making a return higher than that. So which is okay. And I said, additionally, a gross profit margin of 54.7% on every 1 naira of sales, not profit, gross profit margin. A gross profit margin of 54% on every 1 naira of sales is also impressive. And I told them that, but an asset turnover of less than 1 times seems less impressive. Because the asset turnover is 0.8 times. Now, this guy is not even able to turn his asset around, even once. That's less impressive. That was profitability. Then Jerry, I told them that the Badari PLC has a considerable finance cost and an increasing level of debt in its capital structure, considering the increase by 40 million in the debt level. You see, before I made this statement, because when it comes to debt or gearing, we are talking about level of debt. I went to look at the interest they are paying, 5 million. I can't say whether it's good or bad because there's nothing to compare it with. But on going to the statement of financial position, I saw this sharp increase in loan notes. Well, okay, that means there's an increasing gearing level. Then that informed my opening statement that they have a considerable finance cost and an increasing level of debt in its capital structure, considering the increase by 40 million in the debt level. And I told them that it is, however, important to compare the debt amount with the equity to understand its level of gearing. So gearing really is really looking at, okay, compare debt to equity. If debt is so much, then you are highly geared. If it is not, then you are okay. So that's what I'm telling the examiner. Then I said, hence, we will compute debt to equity ratio and interest cover to determine the gearing of Badari. Then I did debt to equity ratio, debt over equity. The debt is that loan note of 50,000. The equity is 560. I got 8.9%. Interest cover, which is PBIT, all upon finance costs. The PBIT, I had to work it out myself. And this is what I did. I went to P&L. I saw that they gave me profit before tax. And I know that PBIT is the profit before you deduct finance costs and before you add dividend received. So I just reversed it. So this one that they have deducted, I added it back. This one that they have added, I deducted it, all from this PBT. Then that gives me my PBIT, which is this. So 286 plus 5,000 minus this. Whatever I got, which is 138,000, I divide it by 5,000, which is 27.8 times. That's impressive. That's good. And I said, following from the above ratios, the gearing level of Badari is low. Is low, which shows that it has very little exposure to financial risk, and banks will be willing to give him additional loans. Debt to equity ratio of 8.9% is low, it's very small. It doesn't have any debt, it's small. Even though it increased by 40 million, but it's small when you compare it to equity. And its profit can cover that interest that he has to pay. 27.6 times. That is huge. Then I talked about investor stake. I said, following from the gearing level, it shows that the investor stake in Badari is high. That means it's the shareholders that own the major part of the business. And the shareholders are very much in control of the company. And that was the answer I will have given the examiner. Even though I didn't mention this part, that they said you should recommend strategies for improving or sustaining them. So this one, you can give them like maybe additional 3 or 4 points. So you can mention some improvement strategies. So those of you in class, can anyone give us some improvement strategies? How do we improve our profitability? Right?
Increase in capital employed.
Mm, well, you can write that, but I don't like that because their investor stake is very strong. It's good enough. So I won't be advising that they should be looking for more capital. Because but I can see here that when it comes to profitability, they should just continue to increase their revenue, increase in revenue. They can even engage in some cost reduction strategies just to make their profit higher. Just to make their profit higher. What again? This asset turnover that is low. So I've already told them they should increase their revenue. Then that can enhance this asset turnover when they do that. Can we get 2 more points? What can they do? What can they do? They can negotiate reduced cost of capital, from debt holders. What again?
They can also increase their receivables collection period.
But we didn't compute receivables collection period, so we don't know whether it's good or not.
Okay.
So making comments on that. Okay, so I can see their debt, their inventory level is quite huge. So they can maybe
Maybe increase in sales level.
which was my first point here, that they should increase their revenue,
Okay,
right?
okay.
So what can we advise them? That inventory level that is very high, I'm looking at what I can say to it. They need to do something about it. They can't just leave it like that. It's
Maybe
quite high.
improve productivity.
Sorry, what did you
They
say?
can also-
I can't hear you.
they can increase their
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 quick ratio. They should be able to manage it for inventory to reduce.
No, it's not clear. Managing quick ratio doesn't translate to managing inventory.
Aggressive sales campaign
Thank you
and
very
employment.
much. Yes. Engaging aggressive sales and marketing campaign. Yeah, I agree with that one. With that, you can reduce
Inventory.
they will reduce that inventory. See, you see, look at the way we developed points together. If I was in the exam, the way I'm answering this is not like I went to dub from somewhere or I went to copy. I sat down. This is what I will have done. I just want you guys to just also sit down, be in that position in the exam. Don't be scared that I did not read this one. No, I've not. ICANN exam is not about. You would get into the exam, you will see something else entirely that I did not even talk about. But don't allow that to throw you off balance. Sit down, relax, express yourself. Write things that make sense. It is not about what you have read alone. It's about what you have known over time from experience, from even another course. You can apply what you learned in another course. Bring it to FR. Join everything together and pass the exam. Okay, so that's that. Then there was another question in Skills May 2024. So let's go to the requirements. What did that one ask you to do? So this one says that he said we should
Hello, sir,
calculate.
sorry.
Yes.
I dropped a message. I dropped a question in the message. Try to pull it up.
Okay. You said, why did we deduct dividend received to get BBIT? Okay, yeah, that's the template, right? So you see, at this point, if I cut off from this point, whatever we get is PBIT. PBIT is after you have gotten PBIT, then you then deduct finance costs, then add your finance income. This dividend received is finance income. So I just walked back. Since they gave me PBT, okay, which is 286,500, then I added back my finance costs. I deducted my dividend received that they have added before so that I can come back to this point. You see, this point is PBIT here. So if you go and check that template, But the way they structure this question, they have already given me this question this way. So this 286,500, I added back this, I deducted this to get my PBIT. Okay? Okay. So they asked another question on ratio last diet. So last diet alone, ratio was like 30 marks for you. Last diet. I pray that they bring it like that again, this diet. You won't have any excuse not to pass. When ratio alone is 30. So they said calculate the following ratios for the year ended December 2021 and 2022. Operating profit margin, ROCE, net asset turnover, current ratio, interest cover, gearing. And gearing, they already told us how you should get it gearing. Debt to equity, 6 marks. So that shows you that this is 1 mark per ratio. Then I said for calculation purposes, all loan notes should be treated as debts. All loan notes should be treated as debt. Okay. B, they said you should comment on the performance and position of Lamido Limited for the year ended 2002 and highlight any issues which Lamido Limited should be considered in the near future. Should be considering in the near future. Okay, good. So I've seen what they want me to do. Then quickly let me compute these ratios. So without any time delay. First is operating profit margin. So when you see operating profit margin, that is your PBIT over sales. It's just like a gross profit margin, which is your gross profit over sales. Then I wrote the years, I wrote the level of rounding off. Then now the question did not call PBIT. They called it profit from operations. This one. Profit from operations is the same thing as PBIT. And it's also the same thing as operating profits. You see, is underneath it, they brought in finance costs. That is your PBIT. So my PBIT is 12.3 in 2022 and 18.6 in 2021. And they also give me my revenue up here. So I can easily get my PBI, my operating profit margin. So my PBIT over sales multiplied by 100, 7.98%. My 18.6 over sales, 11.69%. I move to the second one, which is ROCE, returns on capital employed. So I did also PBIT all upon equity plus debt. You know, your ROCE is profit over capital employed, right? So I intentionally use PBIT because I have my PBIT here already. And anytime the profit I'm using is PBIT, I have to use capital employed, which is equity plus debt as my capital employed. Okay. Then I have my years and my Naira sign. I put it there. So my profit from operation, the same thing as above, 12.3, 12.3. Then my equity and debt. This is my equity and these are my debts, right? So where is it? In my statement of financial position, here is my equity. This is my equity. Equity, equity. And my debt. Debt is this one and this one. Even though there's current and non-current. You see, the examiner gave us a note. They know what they are doing. They said for calculation purposes, all loan notes should be treated as debt. So if you go and pick only this one, you are wrong. You must pick the two. You must pick the two. This one and this one. So that's why this is my equity. This is the debt under non-current. This is the debt under current. I did the same thing for the previous year too. Then I get my ROCE, 2022, 3.59%, 2021, 8.67%. Then my net asset turnover, which is my sales over capital employed. I use my equity plus debt also. I put my year and my Naira sign. I already have my sales up here, so it's becoming easier. I will have just dumped from here. And I already have my equity plus debt up here, but I just put it again for them. Don't forget, asset turnover is times, number of times. I got 0.45 times and 0.74 times. Then my current ratio, which is current asset over current liabilities. I did that for them. So current ratio is 0.53 ratio 1. Y in 2021 is 1.21 ratio 1. So, I mean, by the time you do this on your calculator, what your calculator will give you is 0.53. So you must remember to put ratio 1 there. While this one, you also just do it right. Then the next one, they want us to do interest cover, which is my PBIT over finance cost. So I already have my PBIT, and my finance cost was given to me from the question easily. 2022, 1.3 times, 2021, 1.82 times. And my gearing, which is debt to equity. So my debt is the one under current and the one under non-current over the equity. The same thing for year 2. So 2022, 78.3%, 2021, 379%. I will have gotten 6/6. I want to get 6/6 here. I'm not joking at all. Now, they ask you to comment. The comment is 14 marks. Guys, you must get 14/14. Anytime they ask you that you should make comment on a ratio, do this, I'm going to tell you now, and get 14/14. Except if the guy just wants to hold some of his marks for whatever reason open to him. Look at it. When they say I should comment on performance and position, all I just need to do is to comment on all of these ratios. I will pick them one by one and I'll comment on them. The only thing is that I told the guy that I started with the heading that I should comment on performance and position of Lamido Limited for the year ended. I put that. Then I went straight to my solution. I said, I told the guy that in order to comment on performance and position of Lamido, I told him that I will analyze and interpret the profitability ratios, liquidity ratios, and solvency ratios as computed above. I told him. Then I started profitability ratios. I know from the ratio I computed above, I know that the profitability at the operating profit margin, the ROCE, and this one. I know that the liquidity is just this current ratio, and the solvency is interest cover and gearing. So I arranged it that way. I started with the profitability. This is how to analyze ratio. It's not more than this. Profitability, I said, the operating profit margin of Lamido declined from 11.69% in 2021 to 7.98% in 2022. And I would say that this shows a decline in the amount of profit that is made on every _1 of sales. That is it. I've shown understanding of this ratio. I've told him that when an operating profit margin is declining, it means that there is a decline in the amount. See, this statement here, I've interpreted this ratio. I've explained this ratio because I've told them the meaning of operating profit margin. There's a decline in the amount of operating profit that is made on every _1 of sales. I went to the next one. I said, the return on capital employed declined from 8.67% in 2021 to 3.59% in 2022. I said, this shows a decline in the profit that is made on the capital invested by the business or in the business. The capital invest, because that's the meaning of ROCE. The profit that you make on the capital that was invested. Then I went to the net asset turnover. I also told them that this one also declined from 0.74 times in 2021 to 0.45 times in 2022. I said this shows also a decline in the number of times the entity can convert its capital to sales. I moved to liquidity, which is the current ratio. So this one also declined from 1.21 ratio 1 in 2021 to 0.53 ratio 1 in 2022. This also shows a decline in the availability of highly short-term assets to settle its highly short-term liability. If you see the trick I'm using, so when the first statement is to explain or tell them the movement in the ratio. If it's doing well, the term I've chosen is, okay, improvement. If it's not good, I'll say decline, right? I will now stop there. I will now tell them the meaning of that ratio, what it implies. I said, this shows a decline. And then when I had to expressively tell them what current ratio means, a decline in the availability of highly short-term assets to settle its highly short-term liabilities. Then I went to solvency, which is the interest cover. I said this interest cover ratio declined from 1.2 times in 2021 to 1.34 times in 2022. Because this is a decline too. I said, this shows a decline in the number of times the profit from operation can cover the finance cost. I went to gearing. I said, this reduced from 379% in 2021 to 78.3% in 2022. You see, reduction in gearing is an improvement. I said, this shows an improvement in the level of gearing, and this implies a reduced level of financial risk. See, if you keep things simple, you will not only pass, you will pass excellently.
Excuse me,
Excellently.
sir, 7.9% or 379%.
Which one? Which one is that?
The gearing ratio, is it 37.9 or 379%?
It's 379%. From what we completed here.
Okay.
It's 379%. So, going from the question again, the question did not just ask us to comment. They say you should highlight. So always look for this conjunction. And when you see them, see just like the way they asked these other ones too. This last diet question. And you need to be careful and recommend strategies. They're asking two questions, so it's not one. No. So you need to answer what they want you to answer. So they are saying you should comment. And so they said issues to be considered in the near future. I said that following from the above analysis, Lamindo is not doing well because everything is just declining. It's not doing well in respect of profitability, liquidity, and solvency. And you should note something. The way I've answered this, I use very simple language. The way I will have, it's the way I'm thinking it. Simple, expressive, the way I understand it. No unnecessary grammar. And it's very clear. And then I told them that though the gearing ratio improved, I told them it's not doing well in terms of profitability and liquidity and solvency. I said, though the gearing ratio improved, though, but the company is still highly geared because it is 78.3%, which is higher than 50%, considering the formula we used. So it's still high. Therefore, I said he must consider the following issues in the near future. Number one, increasing costs. I said the cost of hair, where I got those points from is these two paragraph. Number one, this guy is delivery volumes didn't change, and its licenses is renewing its licenses in 3 countries. And they said it's resulted in increase in fees, and he has to operate in these countries. And the operating license in 5 other countries are also due. So, I mean, there's a lot of cost for him to incur. From this point, I was able to then, which is where I came from, saying that okay, there is increasing cost. That the cost of renewing existing operating license are increasing, and it has many unrenewed licenses. I said this will further increase its costs and deep its already bad performance and position. I went to cost management. I said it needs to employ cost reduction techniques to improve its profitability and liquidity position. I said it needs to increase its revenue. It needs to improve revenue so it can match the increasing cost with the increased revenue, because there's nothing it can do about these licenses. It has to renew it. So you just need to increase its revenue. I told him about the perception of investors. I said he must ensure he makes reasonable profit to compensate shareholders for their investment and trust in the company. Otherwise, he will be in trouble. Oh. Now I talked about the cost of capital. I said he must negotiate a reduced finance cost with debt holders in order to improve interest cover, because interest cover is in bad shape. It's 0.20 times. That's very bad. Where's the interest cover? 1 point something times is not good. Small. So it needs to negotiate a lower interest so that, and you can even raise more points. But this is just how many marks correction, for heaven's sake? It's 14 marks. So and the way the examiner marks, each of these, your analysis, they are giving you 2, 2, 2, 2, or 1.5, 1.5. Each of these analysis you're doing, 1.5, 1.5, because explaining this, mentioning this decline and this other one, when you tell them the meaning, what it shows is that is an analysis is no more than that. Anything you are doing is just extra, or probably maybe the examiner gave you some information that you can use to further explain why there is decline. But in the absence of that, this is analysis. Then this one also, I mean, I intentionally give them 5 points. I'm just looking at around 3 to 4 marks here, along with the 10 marks I will have gotten. I want to get 14 over 14 in this instance. So this is how you would have successfully gotten 20 over 20 last diet. Any questions? Okay.
Sir, please, can you explain, can you give more explanation on this? It's still highly geared. There's a particular place you mentioned that I don't think if, like, I really want to understand what that means, sir.
Let me
There's a
go
particular,
there. Where
I
is
think
the
it's
analysis?
all
Jerry,
this,
look at it. Abi?
yes, it is. Yeah. But it's still highly geared. This
Okay.
particular, yeah.
So this 78.3, this 78.3%, right? Even though, yes, its Jerry level declined, reduced from 379 to 78.3, right? But it's good. I told them it's an improvement, but the company is still highly geared, because let me look at the formula we used. Well, even though we use debt to equity highly geared level for debt to equity is 100%. If I had used debt to equity, if I had used debt over equity plus debt, right? That is another formula for gearing. Then I will be looking at around 50%. For anything above 50% is highly geared. But just to drive home some points, considering its poor profitability and liquidity level, 78.3%, I don't want to rub hand on his head and say that it's okay. I still have to say it's highly geared for a company that is having poor profitability. Even though, yes, for a normal company, considering debt to equity, that formula, highly geared, is over 100%. That's highly geared. Okay, so that's that. Any other question?
Yes, sir. And mine will just be to ask if you have a prepared note on this ratio and that you can send to us for further review.
Yes,
Hello, sir.
I will share it. I've actually shared it before, but I would please just remind me on the group so that I can share it too. I will just re-forward it from the group. I've actually shared it before, but I will share it again.
All right, sir.
Is this note that I'm actually looking at this form that I will just share with you. I'll just share the entire thing with you. Any other question before I move to November diet? Okay, let's look at November diet together. November 2023. So that diet, since I've been seeing ratios, this is one of the most difficult ratios I've seen so far. So it said required. It said, as a financial analyst of Shison PLC, this is the name of one of our students, Shison. At least you'll have answered this question in the exam using their name. They now said, we calculate the ratios for Oilwood Limited after making appropriate adjustments to the financial statements for notes 1 to 4. And they give her 10 marks. 10 marks. We will calculate the ratios. And I said, draft a memo. Anytime they say draft a memo, my students, draft a memo. Don't ever omit giving them a memo. It's extremely important. Then I said, draft a memo for the consideration of the MD of Shison PLC, commenting on the performance of Oilwood. So 10-10. So let's now go to the question. Now I know what they want me to do. They want me to recalculate ratios, right? Yes, Esther. Net asset turnover is the same thing as asset turnover. It's sales over capital employed, right? So mostly, I mean, when I say asset turnover or capital or net asset turnover, I'll just do sales over equity plus debt. Like that's what I do steady. I'm very consistent with it. So they said Shison PLC experienced rapid growth in recent years through the acquisition and integration of other companies, right? Shison PLC is interested in acquiring Oilwood Limited, a retailing company, which is one of several companies owned and managed by the same family. Okay, Shison is interested in acquiring Oilwood, a retailing company, which is one of several companies, okay, owned and managed by the same family. So Oilwood Limited is managed by a family. Okay. Which is one of the several companies owned and managed by the same family. Okay. Then I said the summarized financial statement of Oilwood. So they gave me their financial statement, everything. Okay. All right. So then I gave us some notes. And I said from the above financial statements, Shison PLC has calculated Oilwood Limited. He has calculated for it the ratios below for the year ended December 31st, 2022. It has also obtained the equivalent ratios for the retail sector average, which can be taken to represent oil wood sector. Okay. So they gave us ratios of oil wood and the industry. And they gave us 4 ratios: returns on equity. And they now said, including directors' loan accounts. So that means these returns on equity, that means they have considered directors' loan account as part of equity. Okay, I will note that. They also gave me net asset turnover. They gave me gross profit margin. They gave me net profit margin. Good. They now said from inquiries, Chisom has obtained the following information. They said Oyowood Limited buys all of its inventories from other family companies at a price which is 10% less than market price. That means this is not, they are using related party, whatever. I'm sure this guy cannot buy it at that. If it's not that he's buying it from another family company. So those ones are selling it for him at a lower price, 10% less. We cannot use that for our ratio. We have to update it to the market price. Otherwise, that ratio will be distorted. Because if its cost of sales is 10% less, so it doesn't make sense to be comparing whatever we use cost of sales to compute with industry average, because other companies in the industry are buying it at market price. Because him is within a family conglomerate, he can buy it less. No, that cannot work. It has already defeated comparability, but we'll adjust it. 2, they said after acquisition, Chisom PLC would replace the existing board of directors and need to pay remuneration of 2.5 million per annum. Okay. Okay. 3, so the director's loan account would be repaid by obtaining a loan from the same amount. Now we'll start paying interest at 10% per annum. Okay. They said Chisom PLC expects the purchase price of Oyowood to be 30 million. And net assets are equal to equity plus the loan. Okay. Required. Okay. We calculate the ratios. Now, the only information I can use to recalculate these ratios, these 4 ratios given, are these 3 information they gave me. So, I will need to update this inventory because this guy is getting inventory cheaper. So, if I now use that as a basis to compute my ratio, that will be misleading because I cannot compare that with other industry that are buying it at market price. So I will need to update its cost of sales. I will need to update it to market price. So I will need to update it to market price. You will see how to do that. Secondly, they said, after acquisition, they said, Chisom PLC will replace existing board of directors. I need to pay. So that means this one, I would need to increase this director's salary. I will need to increase it from 1 million to 2.5 million. They say that this guy is going to repay director's loan, but he will collect another loan. So, I mean, he's in and out. But now we'll start paying interest of 10%. So that means I will need to compute finance costs of 10%. How much is the director's loan, Seth? Okay. It was 10 million and it was interest free. So that means since he will be paying 10% now, that's like 1 million per annum. So I will need to go and deduct that again. And Chisom wants to buy Oyowood for 30 million. So that means the net asset of Oyowood is 30 million. That's what it means. So look at the way I did my solution. I said the following adjustments needs to be made. I said 1. I said inventory needs to be updated to the market price. I said when Chisom PLC acquires Oyowood, the incentives it presently gets from other family companies by buying at a price which is 10% less than market price will be denied. Because as soon as Chisom buys Oyowood, Oyowood will no longer be part of those other companies that is run by the same family anymore. They will see Oyowood as part of Chisom now. They will not sell to him at 10% less again. So the cost price would therefore be imparted as follows. You see, in P&L, the cost price they gave me is 45,000. And I know that this cost price is already is lower because this guy has been getting goods at a reduced price. So this cost price is like at 90% because he gets these goods at 10% less than the market price. So this 45,000 is 90%. So you need to know how to bring this 45,000 that is 90%. You need to know how to gross it up to 100%. So however you know how to do it, just gross it up. This is how I do it. I said, I did 45,000 divided by 0.9. That's 50,000. And I want to explain to the examiner in case he has another way. I told him that note that Oyowood has been buying at 90%. That is, he gets 10% discount. And I told him that, so to bring it to 100%, he said, I will simply divide the cost of sales by 90%. That is, grossing up to 100%. That's how to gross up. This 45,000 is 90%. Divided by that 90%, it takes you to 100%. Right? Which is the same thing as 45 over 90 times 100. It's the same thing. That's one. Two, I said director's remuneration will be increased to 2.5 million in the P&L. That's the second adjustment I will make. Three, interest on loan of 10% of 10 million, which is 1 million, will also be recognized in P&L. And I said net asset of Oyowood is 30 million. That is equity plus debt. Then I said adjusted P&L because since new figures are coming in now, nothing is happening to the revenue. It's still 70K, just as it is here. Where is it? Where is it? Yeah, 70K. But my cost of sales now has changed. It's not 45,000 anymore. My cost of sales is now 50K. Then I get my gross profits. Nothing has changed to this. But my director's remuneration now, it was 1 million before. From here, where is it? It was 1 million before. Now it is now, they told me that we're going to be paying 2.5 million. So I update it to 2.5. 2.5. So my PBIT is 10.5. I was not paying finance costs before, but now I'll be paying 1 million. So I removed 1 million, bringing it to 9.5. So nothing is happening to this. So my profit for the year is now 6.5. So it's because of this adjustment the examiner wants you to do. That's why I said this is like the most difficult I've seen so far, where you need to prepare your figures before you then compute your ratios, which is what the examiner wants. So computation of ratios. So they asked me to compute ROCE, which is PBIT over capital employed. So my PBIT is 10.5, meaning the recomputed PBIT all upon the capital employed. I use 30 million, which is this one that they said they will buy Oyowood for 30 million. And they told me that is equity plus debt. So that's the value of Oyowood now, not the one in the balance sheet anymore. So I get 35%. My net asset turnover, sales over net assets. Sales is 70. I just use my capital employed here. I told you that for net asset turnover, I always use equity plus debt, steady. So 30,000. I get 3.2 times or 2.3 times. My gross profit margin is gross profit over sales. My gross profit up there is 20,000, sales is 70,000. I get 28.6%. And my net profit margin, you see, when you see net profit margin, see it as operating profit margin. See it as operating profit margin. So, which is 10.5 over sales. I get my 15%. 15%. I will have gotten my mark. How many marks? That's 10 marks. If you're lucky to have done.
Sorry, sir. Does it mean that net assets equal to is the same thing as equity plus debt?
Yes.
They are the same thing as capital employed.
Yes.
All right, sir. Yes, sir.
Hello, sir.
Yes, Obafemi.
Yeah, this capital employed, I think we have another formula that is total assets minus current liability. So, in what instance can we use that formula? Because the one you are using so far is debt plus equity.
Yes, so you can use that other one also. See, it's consistency, is a choice, it's an approach.
Okay, but if we use that one too, it's fine.
Yes, of course. Yes, it's fine.
Yeah, I just want to
But
confirm.
it will still give you the same results.
Okay.
Yeah. So I just find this one easy, like straightforward. Equity plus debt, which I would advise you to do. But if you are used to those other ones too, it's fine. What is important is don't fail. So that's the A part. The B part, draft a memo for the consideration of MD of Chisom, commenting on performance. I always like this when they say commenting. See, this one is more important than the ratio. Ratio is important, fine. But when they say comment, discuss, analyze, it's something you can get 10 marks. So they say they want you to comment on performance. Just comment on all the ratios you computed one by one. We'll see, because all of them are performance ratios anyway. They are all profitability ratios, all the four. So that's why they specifically mentioned performance. And they said memo. And it's not difficult to just put from, I think they say you are the financial analyst, I guess. Didn't even pay attention to that. Okay, as a financial analyst. So it will be from financial analyst, not from accountant. So whatever name they call you, you put it there. To MD. Abi? Who did they say we should write it to? Yes, MD. So to MD. Subjects. What they want me to do, that I should comment on performance of Oyo Wood. Dates. I usually put the year end. I just put the year end there. I will just go and look at their balance sheet, which year end, December 2022. That is what I'll put as my dates. And I move on. Then I go to my body. However you want to do your introduction, memo should have and introduce them to whatever you want to do before you start. I said the subject matter refers. I said the following paragraph, use the ratios computed above to comment on the performance of Oyo Wood. Then I start picking the ratio one by one. You will see the same pattern that I use in analyzing. That's how, whatever exam I see on ratio, this is how I will analyze it. Anytime, any day. They said, the return on equity of Oyo Wood is 35%. I mean, that was what we computed, 35%. And I put comma. I said, well, that of industry is 22%. Because that's what they gave me in the question. Abi? Where is it? Yes, 22%. Not only that, this shows that Oyo Wood makes more profits from its available financial resources than other companies within the same industry. It's making more profit, 35 against 22. I went to the net asset turnover of Oyo Wood. I said it's 2.3 times, while the industry is 1.67 times. I said this shows that Oyo Wood is more efficient in the use of its capital employed to make sales than other companies in the same industry. I went to the gross profit margin. I said, Oyowood is 28.6%. Industry is 30%. I said, this shows that Oyowood makes less gross profit from every 1 naira of sales than other companies in the industry. Then I went to the net profit margin. Oyowood is 15%. Industry is 12%. This shows Oyowood makes more profit before interest and tax from every 1 naira of sales than other companies in the same industry. I said, following from the analysis above, Oyowood PLC is more profitable company than the companies within the same industry. Thank you, my name. That's it. I will have gotten majority of my marks because there's no reason why this guy will not give me my 20/20, keeping it as simple as possible. Okay, that's that. Let's go to the other diet. I'll just do, after this one, I'll do one more, then we'll be done. So skills, May 2023. So this particular diet, they only asked one question on ratio, which is just 6 marks. So, and what they ask us to do is that you should prepare a memo memo to the FD explaining the ratios and highlighting the limitations of each of the ratios as a tool for analyzing financial performance. 6 marks, just 6 marks for that. For those that wrote that diet, you didn't really ask much on ratio that diet. So this is the question. It says, some new trainee accountants in your organization were engaged in a discussion in which they proclaimed that EPS and ROCE are the best ratios for analyzing financial performance of an entity. They said the finance director who overheard their discussion have requested you as the chief accountant to prepare a brief on the aforementioned ratios, which would be used during the forthcoming in-house training. Okay? Let me give them what they want. Memo from the chief accountant to the finance director, subject earnings per share and ROCE and their limitations, dates, the year end that they gave me in the question. So what the question want me to do is that to prepare a memo explaining this ratio and highlighting their limitation. I just explained it way as simple as possible. I said this ratio is calculated as profit attributable to ordinary shares divided by weighted average number of ordinary shares. I said it measures the amount of earnings of an entity that is due to each ordinary shareholders. And I told them that the higher this ratio, the better. That is what I know about EPS, and that's exactly what I will tell the examiner. ROCE, I said this ratio is calculated as the profit from operations divided by capital employed. And I told them what it measures. I said it measures the amount of profit an entity makes from its available financial resources, both from equity and debt holders. And I told them that the higher this ratio, the better. And I went to limitation of EPS. In the exam, if you can get 2, you're fine. I said EPS does not consider cash flows generated by the entity. I said it does not consider the size of the entity. A small and big entity can have the same EPS. So it doesn't care whether is your own profit that is bigger or it brings it to the low level. I said it can be manipulated by decreasing expenses of buying back shares. Can be manipulated. I said it does not consider the effect of inflation. Is nominal profit it considers, is the book profit it considers. And it does not consider the debt level, which is a critical measure of financial health. Limitation of ROCE. I said it is based on companies' past performance, so it doesn't accurately reflect present and the future. I said it is not comparable across sectors because companies in different sectors use capital differently. And it assumes that all companies have the same risk profile, which isn't true. I mean, just like the way EPS assume it does not consider the size of companies. These ones too, it doesn't consider the size of company because it's assumed they have the same risk profile too. And it does not consider cost of capital. So a company with an IOC may not be generating enough earnings to cover its cost of capital. Just like in Nigeria, when MPR is like 27.25%. If you are making a ROCE of less than that, you're not doing well as a company. You're not. And I say it can also be manipulated through financial engineering and accounting techniques. Thank you. Yeah. So this was the first diet they will have asked ICAN students this. And a lot of students haven't really seen this before, where they will be asking limitation of a ratio. So you guys are fortunate. In case they ask it again, fine. If they don't, that means you answer whatever ICAN decides to ask. So thank you, my name. That's the memo. Okay, so this is the final question for today, which is November 2022. So this particular diet, they did not ask published. So they asked this question as question 1. It was 20 marks. I consider these students lucky that I was just compute ratios and analyze. So there's nothing difficult there. So they want us to compute these ratios here. And they want you to draft a report. When they say draft a report, it's just similar to draft a memo. The same thing, the same format. Same thing, the same format. So draft a technical report and call it performance scorecard of Blessing and Grace and advise favor on which of the two companies it should acquire. 75 controlling interest in 10 marks. So the ratio 10 marks, analysis 10 marks. This kind of questions, which is most likely how they will ask you this diet too. With all this revision we have done together, there's no reason why you should not get 20 over 20. So the question itself, they said there has been agitation to stop importation of containers from China to increase patronage of local industries. They said the board of Favor PLC is planning to acquire 75% controlling interest in either Grace Limited or Blessing Limited, which produce better and cheaper containers locally. As a trainee working in Obokun Chartered Accountants, the MD has requested you to carry out performance scorecard of the companies using accounting ratios to assess viability of the acquisition. So they gave us the P&L of the 3 companies. So we are not really concerned about Favor. We are concerned about Grace and Blessing. So, and they gave us their statement of financial position. Yeah, their statement of financial position too. Let me just put it down here. So they gave us all this. And they gave us some additional information. It says inventories as at the end of 2019 were this, and this. And the current market prices are this for Favor, Grace, and Blessing. They said purchases for cash within 365 days in the year 2020 were this, and 40% of cost of sales for Favor, Grace. Now let us compute these ratios. So first net profit margin. I already told you that see net profit margin as operating profit margin. which is PBIT over sales. So from the P&L, my PBIT for Favor and Grace, this one they gave you directly. So 51,000, 33,000, Grace and Blessing. And revenue is 100,000, 100,000. Okay. So I won't go back. I will not be going back and forth. So for Grace, PBIT 51 over 100. Blessing 33,000 over 100, 33%. Quick ratio is current asset minus inventory over current liabilities. So current assets, this is inventory. Maybe. Okay. Current asset minus inventory, current asset minus inventory. So even though the guy gave me opening inventory here, I ignored it. I used my closing inventory. So ordinarily, a lot of people will have just used average, but I'm not going to do that. You always use closing. So divided by current liabilities. Again?
Is there any reason for that, sir?
Yes, consistency and simplicity. So consistency in the sense that most questions will not give you opening for all of those periods. So, and this ratio is about consistency from year to year. That's why I always use closing like that. So get used to using closing. So you will not run into problems at all at any point in time.
Okay,
so for this quick ratio is 3.7 ratio 1, this one like that. Debt equity ratio is just as the name, debt over equity. So you will see the debts, I use non-current liabilities, not even all the items in non-current. And I noted that in most of these questions in ratios, they don't give you items like provisions, like deferred tax, when they want you to compute ratio. Because even if they give you as part of your non-current, don't consider that debt. When you are doing debt, is only use these non-current liabilities that has fixed interest. Don't go and use all your non-current liabilities. But I've seen that most questions I've looked at so far in your past questions from 2020, 2019, they will just give you what you need in non-current. So I'm using the addition of these two like that. So debt over equity. So the total debt here is 35. This one is 315. Equity. You all know what equity is. Share capital plus reserves. Please, equity is not share capital alone. No. Equity is not share capital and share premium alone. No. Equity is share capital, share premium, retained earnings, revaluation surplus, all of that. So usually you just come to your statement of financial position. This equity here, whatever is there, is what you will use as your equity. So I used it. Grace 8%, Blessing 256%. Proprietary ratio. Okay, so the guys that wrote this diet, a lot of them haven't seen this ratio before. Even me myself, I didn't really teach anybody proprietary ratio. But it doesn't mean that you should not know it. Yes, now. Even from the name proprietary, proprietor is the owner of the company now, Abi. So when somebody is saying what's proprietary ratio, you just wants to know what's the holding of the owners in this company. What's their percentage holding, which is equity over total assets. Equity over total assets. So my equity, I dub it from here. My total asset, I'll go and pick it up there for my total asset. In this case, 510, 560. Let me show you. This is my total assets. 510, 560. That's the proprietary ratio. That will give me the portion the equity holders own in the company. Earnings yield is EPS over market price. That's earnings yield. They want us to compute that. Unfortunately, this question didn't give us EPS, so we have to compute EPS. And EPS is profit attributable to ordinary shares over weighted average number of shares. The profit attributable to ordinary shares is profit for the year. And this guy was nice. He gave you profit attributable to ordinary shares. Like, the way they will have taught you in class is profit for the year minus your preference shares overweighted. That was how they taught you, right? So that's on the assumption that preference dividend hasn't been removed, right? So this one, they have removed preference shares. So this profit is profits belonging to ordinary shareholders alone. So I just use my 33 and 840 straight on for my computation of EPS. So 33, 840 divided by weighted average number of shares. So in calculating number of shares, you will see I did 200 over 1.25, 110 over 1.25. This is the reason. I believe everybody should know how to do that now. The nominal value here is 1.25. This is the value of shares. If I want to get the number of ordinary shares, it will be this value divided by the nominal value. Get used to that. Don't assume. In most questions, you will see the nominal value as 1 naira. So always look at this nominal value. Be sure that if it is not 1 naira and you need to do the number of ordinary shares, it will be this divided by the nominal. So which is why I did this that I did here, like that. Then I was able to get my, EPS. Then I was able to get my EPS. I did it in kobo. If an EPS is always in kobo, EPS must be expressed in kobo. So 20.7 kobo, 0.95 kobo. So now I can compute my earnings yield. So I've already computed my EPS below. They gave me my market price for Grace and Blessing, 28 kobo and 10 kobo in the notes. So Grace and Blessing, 28, 10 for Grace, Blessing respectively. So my earnings, you see I did it in percentage, right? 73.9%, 9.5%. The examiner wants me to also compute my net asset per share. So my net assets all upon number of ordinary shares. Even this diet, I didn't teach anybody net asset per share. I didn't mention it. Even you guys that I taught you ratio in class, did I mention it? No, I did not. So that goes to show that you can see ratios in the exam that I did not mention. So from the name of the ratio, they expect that you should be able to come up with your formula. So this ratio is not just about cramming all of the, yes, cram the ones we taught you in class. But if they ask you the one you have not seen before, don't say I did not teach you. You must create it yourself in the exam. Net asset per share is net asset over number of ordinary shares. There was a diet, they asked cost of sales ratio. I did not teach anybody cost of sales ratio in the class, but I can ask it anyways. Cost of sales ratio is very similar to every other ratio that you know under profitability, like your gross profit margin and the rest. So, and they ask cost of sales ratio, which is cost of sales over sales, right? So, and in fact, that diet itself, even if you know the formula itself, you will not be able to compute the ratio because they did not give you what you will use to get. They didn't give you sales, they didn't give you cost of sales. But all they gave you was gross profit margin. So if gross profit margin is 10%, cost of sales ratio is 90%. Because gross profit margin is amount of gross profit on every sales. Your cost of sales ratio is amount of cost of sales on every sales that you incurred on every sales. So if you are making a gross profit on every sales of 10%, that means your cost of sales was 90%. So we did our net asset per share and we got this. That will have earned me how many marks? 10 marks. Now they want me to do a report and comment, right?
Sure.
To
Please,
that
I don't. Please, how do you get this? How do you convert it to Kobo, please? I'm trying to
This one.
200 divided by
1.2.
200 divided by 1.25 give me 160,000 naira.
Then you then do 33,180 divided by 160.
Okay.
Yeah,
Thank you, sir.
you're welcome.
Hello,
So
sir.
Hello, sir.
yes,
Please, you mentioned of your, you talked about the 12% preference share has to do with debt. I can't really place it, the explanation you gave. I
no,
think it's on the proprietary ratio when we're talking about is it equity or the loan also.
okay.
I don't
Okay.
interrupt.
The explanation that I gave on what exactly? Just I can't remember. Just tell me what you want to know, then I'll come over.
So I want to, please, can you go up and let's see the preference share and the loan? Maybe I will remember what you're trying to say about it. I don't know
This
whether
one.
is the any.
Is
Yes,
it this
sir.
one?
Yes, sir.
Yes, I was saying that debt, whenever you need to use debt, is just those debts that have fixed interest that you should use for your debts when you want to compute whether debt to equity ratios, anything that has to do with debt. So it's just the items that has fixed interests, the non-current liabilities items that there could be some other items of non-current liabilities like provisions, like deferred tax.
Okay,
Those ones, ignore those ones. Those ones are not debt
okay,
for gearing purposes. It's just these ones that has fixed interest. That was what I was saying.
okay, sir.
Yeah.
Hello, sir.
Yes.
Sir.
Go ahead.
Okay, so I missed your explanation on that profit attributable to ordinary share.
Okay, so for EPS now, is the profit attributable to ordinary shares alone over weighted average number of ordinary shares? And I said that the examiner was so nice that he gave you that directly here, because in the sense that they have already deducted preference dividend. I know in class, if you were taught EPS, is usually profit for the year minus preference dividend over weighted average number of shares, right? That's the formula. But here now, that will not fly because they have already deducted the preference dividend. Already, it has already been deducted. So this profits, the idea of EPS is the profit that belongs to ordinary shares alone. So all upon the weighted average number of shares. So just pick these profits directly, which is the profit for the year that belongs to ordinary shares alone. So that means that if in this question, they give you a statement of changes in equity, and in the statement of changes in equity, there is now preference dividend. That one, you have to come and remove it further from here. That means that hasn't been removed from here. You need to remove it so that you can get only the profits that is due to ordinary shares alone. So that is the whole idea around the profit attributable to ordinary shares.
Thank
Okay.
you, sir.
Yeah. Now they want us to analyze. I love analysis because I will just I have a pattern and I give it to them. From accountants to the board of favor, performance scorecard, then the dates. I said the subject matter refers. The following paragraph analyzes the ratios computed above with a view to advising the board of favor PLC on the choice of investment between grace and blessing. Then I pick my ratios one by one and analyze everything. The same thing I've been doing. I said the net profit margin of grace is 51, while that of blessing is 33. This shows that grace makes a higher net profit on every 1 naira sales, right? So the quick ratio of Grace is 3.7:1, while that of Blessing is 0.9:1. This shows that Grace has higher available liquid assets to settle its highly short-term liabilities or obligations. Then I went to debt equity ratio of Grace is 8%, Blessing is 256%. This shows that Blessing is highly geared and exposed to higher financial risk. Then I went to proprietary ratio. I said Grace is 85.7%, Blessing is 21.9%. It shows that Grace finances more of its assets from its equity funds. I went to earnings yield of Grace. I said it's 73.9%. Blessing is 9.5%. It shows that Grace Limited gives higher return to its shareholders than Blessing. I went to net asset per share of Grace is 2.73 naira. Blessing is 1.40 naira. It shows that the shareholders of Grace has more value in the company than the shareholders of Blessing. And I said, following from the above analysis, Grace Limited is a more profitable, liquid, and solvent entity, is more profitable, liquid, and solvent, and would therefore advise favor to acquire Grace Limited. Thank you, Kwasi. Okay, so there are other questions here in the notes, which are previous diets that you can also practice. If you have, after, of course, you have practiced these ones that we have discussed here, then you would be fine.